Hello and good evening, everyone. Today's webinar topic is gold as a portfolio diversifier. So, for this, we have with us Mr. Joydeep Sen, corporate trainer, author, columnist, with over 25 years of experience in the financial services industry, including a long tenure as senior vice president at BNP Paribas Wealth Management. Mr. Sen has been an influential voice in personal finance and wealth management. Since 2017, he has published more than 500 articles in leading financial publications, authored 4 books on investment and wealth management, and regularly appears on CNBC shows, a certified financial planner and visiting faculty at NISM and IMT Ghaziabad. Now, a short glimpse about NISM. NISM is a public trust established in 2006 by SEBI, the regulator of the securities markets in India. The institute carries out a wide range of capacity building activities at various levels aims at enhancing the quality standards in securities markets. Now, before beginning the session, I would like to request all the participants to note some important points. First, questions will be taken at the end during the Q&A segment. Second, all participants will receive a participation certificate within 3 to 4 working days. Third, the recording of this session will be available on NISM YouTube channel. Now I request Joydeep sir to begin with this session.
Thank you, Sahil, for the kind introduction, and welcome to all the audience, all the participants. So we will start now. Now, when I'm presenting, as in I'm showing my PPT, I will not see the chat box. So I will talk for something like 40, 50 minutes. And then as Sahil said, we'll have the Q&A. So it will be a kind of monologue, so bear with me for like 40, 50 minutes. And then we will go for the Q&A session towards the end. So I will share my screen now. I have shared the screen. So Sahil, is it visible?
Yes, sir, it's perfectly easy.
Okay, good. So we start off now. Today's topic, you know it, gold as a portfolio diversifier. Now, mull about the caption itself. The caption is portfolio diversifier. Now, read more into it. We are not saying it is a staple investment, it is a portfolio diversifier. So, what is a staple investment? Equity, debt, these are staple investments. So, what is the difference between a staple investment and a not so staple investment? A staple investment is well discovered, well known, liquid. So here you will say gold also is well known, discovered, and yes, kind of liquid. Then what is the difference? The difference is, as in, at least my individual view, you may agree, you may disagree. Gold is not a productive asset like equity or debt. Why so? In equity, there is a company. The company does something, we know it. So we invest in the ownership of the company. In debt, be it government debt, be it corporate debt, there is a bond or debenture where it is given in writing that will pay so much, like coupon or interest, we will pay so much, it is there. Whereas gold is, industrial application is very limited. It is more about diversification of investment. So I will show the data now. What it shows is that over a period of time, if you have some gold in portfolio, you get better risk-adjusted returns. Now, what is the meaning of risk-adjusted returns? On the context of risk, there may be multiple parameters, like 10 parameters. The most popular one, which we also will show you, is about volatility. So how volatile the performance of the portfolio has been. And from that perspective, if you have some gold in your portfolio, you get better risk-adjusted returns. And when I say sum allocation, what is the meaning of sum? 10 to 15%. So what I'm saying is, for whatever benefit gold has in your portfolio, allocation should be like 10, 15%, not like 40, 50, 60%. Reason I told you, your staple assets are equity and debt. Then you have some gold in portfolio, some real estate, maybe some other asset which you can think of. So that is the context. And before I start talking about gold per se, I will talk about diversification for a bit, for like a few minutes only, so that we're on the same page as to what is the meaning of diversification, because we are saying gold as a portfolio diversifier. So what is the meaning of diversification? So I will just show you 2 slides, but absorb the data what I'm showing you in these slides. What is this diversification? So look at this data. Now this data, this is history over a long period of time. If you can read the small text, this is 10-year CAGR. CAGR as in compound annualized growth rate. 10-year means over a long period of time. So if you can see, if you can read the text, it is from 1997 to 2019. So over this long period of time from 1997 to 2019, it is 10-year CAGR on a daily rolling basis. So it is like this. Data starts from 1997. So 2007 is the first data point in this series. From there on a daily basis with a 10-year gap, 10-year frequency gap, data is taken daily. So over this long period of time on a 10-year rolling return basis, if you had an equity only portfolio, which is towards my left, if you can see, 14.3%. So what it shows is over this long period of time, if you had an equity only portfolio, you would have earned 14.3% annualized. Over the same period of time, if you had a debt only portfolio, you would have earned 9.1% CAGR, 9.1% annualized. And this maroon bar is volatility, and which is measured by standard deviation. So if you had an equity only portfolio, you would have earned so much of returns, 14.3%, and the volatility would have been so much, the height of the maroon bar. If you had a debt only portfolio, you would have earned so much, 9.1% returns, with the height of the maroon bar so much. If you had a gold only portfolio, you would have earned 11.4% return, which, as you can see, is lower than equity, higher than debt. But look at the height of the maroon bar. The volatility is high. So this is the picture about gold only. Now come to diversification. So this, where I'm pointing my cursor now, if you can see the cursor, this is a 50-50 portfolio, 50 equity, 50 debt. So a 50-50 portfolio would have earned 11.5% CAGR return. And look at the height of the maroon bar. It is much on the lower side. It is much lower than gold and even lower than equity. So here, debt is giving you stability. Now towards my extreme right, see the height of the bar, the yellow golden kind of bar, and the height of the maroon bar. This is 45, 45, 10, as in 45% equity, 45% debt, and 10% gold. So look at this, the height of the maroon bar. So you earn so much return, 13.2%. Now this 13.2% is approximately 1% lower than equity only. So over this long period of time, if you had an equity only portfolio, you would have earned the highest return. If we had a allocated diversified portfolio of 45, 45, 10, 45 equity, 45 debt, 10 gold, you would have earned lower returns, but only so much, only like 1% lower. Now the volatility is that much lower, and this dotted line is Sharpe ratio. So Sharpe ratio is a measure of risk-adjusted returns. So this is the highest. So basically to say that over a long period of time, if you can identify the highest yielding asset, and if you invest 100% in that, yes, good for you. Over a long period, you get a good return. But if you have a properly diversified allocated portfolio, then you get better risk-adjusted returns, which is why, so you can have any combination as per your suitability. I'm showing you one combination of 45, 45, 10, as in 45 equity, 45 debt, 10 gold. I will now show you another slide, but the message there is similar. So here I am showing you certain portfolio allocations. Now this also is over a long period of time. So look at this. This is long-term returns of different asset allocation splits. So if you had an equity only portfolio, your 20-year return would be 14.4%. Numbers may be different because of different sources, different computation methods and all that. Your 20-year CAGR, that is compound annualized growth rate, would have been 14.4%. Now this red portion is drawdown. What is drawdown? Drawdown is when your return is peaking like this, like the curve is going like this, something happens and a correction happens. So from this point to the bottom, and then again market starts recovering. So from the peak to trough, how much it has fallen, that is called a drawdown. So from the highest point where you start counting, and after that where it makes the bottom, that is called drawdown, which means over a long period of time, while equity only has given you 14.4% return, at some point of time, you would have suffered a 60% market correction. So equity only, you have to be prepared for that kind of volatility. Over 20-year period, if you had a gold only portfolio, same 14.4% CAGR, 14.4% annualized, your drawdown would have been 29.2%, which means at some point of time, from the peak to the trough, some point of time, you would have suffered 29% loss, as in paper loss, not real loss. If you sell, it is real loss. If you don't sell, it is paper loss only. Now, over the same long period of 20 years, look at the various combinations. This combination, where I'm pointing my cursor, equity 70, debt 15, gold 15. So look at the return. It's even higher, 14.6%. And the drawdown is lower than equity only, but higher than gold. Another combination, equity 70, debt 30. Your return 13.2%, so lower, and drawdown at 40.3, so similar. Which means if you eliminate gold, if you have 70 equity and 30 debt, you get so much return, little lower. If you have 70 equity, 15 debt, 15 gold, your return is higher. And volatility drawdown is kind of similar. So other combinations, equity 50, debt 25, gold 25. You can see here 14% return, but volatility drawdown is lower. And here equity 50, debt 50. So eliminate gold and debt only. See returns are lower, 12.1%. So if you have some gold, you get higher returns, and volatility is kind of similar. Another last combination, equity 30, so more defensive kind of portfolio. 30 equity, debt 35, gold 35. You see here 13.3, little lower, but the volatility is that much lower. Drawdown is that much lower. And if you have equity 30 and debt 70, no gold, you can see returns are coming down. So for volatility, we have two measures, as in there are multiple. I'm showing you two as of now. Standard deviation is measured over the period of time, like 10, 20, 30 years, over the entire time period, it is measured. Whereas drawdown is a peak and the market falls, market corrects. The maximum correction in that period of time is called a drawdown. So that gives another different picture of volatility. So this gives you a sense of, why you should do diversification, why you should do allocation. Now I come to gold as such, what gold has done historically. So look at this long period data. You see here, the returns data starts from January 1980. So it's a long period of time. So you can see here from 1980 to 89, I'll show you more on these, 1980 to 89, 0% return. See this curve is going, gold price curve. 89 to 96, 12% CAGR, 12% annualized, not bad. Then 96 to 2002, again 0% return. 2002 to 12, 19% CAGR, good. Gold is doing well. Again, 2012 to 2019, 0% return. Again, long period of this thing. And then you see it is shooting up. Now it is going up only. So market correction, in the market, there are two types of correction. One is called price, one is called time. Price correction is what you all know. The market corrects, like the equity market corrects. And time correction is over a long period of time, you don't get any returns. You get zero return. That is called time correction. So as you can see here in gold, price correction is not as much. I mean, there was some drawdown I showed you in the previous slide. Drawdowns are there. But if you look at it over a long period of time, it is not so much of price correction, but it is more about time correction, as in you may have to go through long periods where gold does not give you anything. Gold gives you zero return. So you have to hold on to it for a long period of time for gold to give you returns. So now I come to the details of this thing, that time correction. So look at this period, Jan 90 to November 89. So gold price is here. You can see the green bar here and the green bar here. So over this long period of time, gold price fell. It is going like this, and then it peaks and it comes here. So over this long period of time, you get zero return. So some more about this thing. 1996 to 2002. Again, over this long period of time, same story. The green curve here and the green curve here. So it took so much of time, about 7 years or so, to touch the previous level. Again, 12 to 19, about 7 years, same story from here to here. Another case of time correction. So now when we look at a long period of time and various time phases, so what we see is gold has delivered more than 7%. 7% means annualized per year. More than 7% per year returns 2/3 of the time across 7-year period. So I'll show this you in more in detail. So this is rolling return, compound annualized rolling return of gold since inception, that is January 80. Data starts in this source from Jan 80, not for gold as such, from this source I made. So from then, annualized return, compound annualized return on a rolling basis. So what we see is over a 10-year holding period from 1980 till date, over a 10-year holding period, your average return has been 10%. And look at various periods, 15, 12, 10 years, 7 years, 5 years, same as in 10-year average return. Where it differs is the maximum and minimum. So see here, if we have a 1-year time period, at some point of time, you have minus 33%. If you have a 3-year period, you have minus 10%, 5-year period, minus 10%. So negative incidences can happen. 7-year time period, minimum is minus 3%. Provided you have a 10-year horizon, gold does not give you negative returns. You get at least positive 1% minimum return and maximum is 21%. So look at the maximum for 1 year, it is as high as 77%. For 10 year, it is somewhat lower, I mean, not low as such, somewhat lower at 21%. So average is similar. It is the range, the maximum minimum range that comes on. It means it becomes more stable, it becomes less volatile. And like we said in the headline, 2/3 of the time, so you can see here, 66%, so 2/3 of the time. So if we had a 7-year horizon, like if I can see my cursor, 7-year horizon, greater than 7%. So like greater than 0%, 7-year horizon, 1% times, less than 0%, that is negative. Less than 7%, 34% times. Greater than 7%, 66 means 2/3 of the times. Greater than 10, 45% times. So if I want at least 7% return on a 7-year horizon, 2/3 of the time, I have got that return. So 7% is kind of not very good, but at least inflation kind of return it has given. So what we see here, longer the time frame, the better. Where average is same, the maximum minimum is better. So like here we saw, less than 0 means negative. On a 7-year horizon, yes, there is 1% chance of getting negative returns. Longer the horizon, the negative incidence comes down. Like we see here, 10, 12, 15, negative incidence is 0. So longer the horizon, the better. Now the question is, as I said earlier, equity is the staple asset class. So what about equity? If we have to compare equity and debt from this perspective. So again, you can see history here. Longer the time frame, equities have lower odds of negative returns versus gold. So this graph, what I'm showing you now, what I'm showing is percentage instances of negative returns since inception. So if I had a 1-day horizon only, for the long period of time, if I had only 1-day horizon, you can see here, gold, 48% chance of giving negative return, and equity, 46% chance of negative return. If I had a 1-month only horizon, gold, 45% chance of negative return, and equity, 38% chance. So now come here, 1 year, gold 25, equity 23. 5-year, see the difference here. Gold still has 11% chance and equity has 0.1% chance, and 7-year, 10-year, equity 0%, as in equity does not have any chance of giving negative returns. So both over a long horizon, both equity and gold are good, but equity is relatively comparatively better than gold as long as you have a long horizon. Better as in the possibility of getting negative returns is that much lower in equity than against gold. Another reason why I'm saying equity is a staple asset class, gold is a portfolio diversifier. Diversifier means you allocate 10 to 15% to gold, you get better risk adjusted, better volatility adjusted returns over a long period of time. So some more about volatility. You can see here the various calendar years. So this red bars dropping downward, downward means below the 0 line. That shows drawdown. Drawdown means over that calendar year, what has been the worst return? You can see here 1980, 40% at some point of time. 1981, 25% loss, as in paper loss. If you have not sold, it's not a loss as such. 1982, 23% drawdown. So at some point of time, you have suffered negative return on paper. And over this long period of time, the average is 13%, which means basically 10 to 15% declines happen almost every year. The average is 13%. So on a calendar year basis, drawdowns do happen in gold. Now the positive part is, now I'm showing you the calendar year returns, which shows in spite of drawdowns, what has been the return from gold across calendar years. So 1980, look at this, it's phenomenal. Drawdown was minus 40% at some point of time. Your gold investment on paper showed minus 40% returns, but over the calendar year, gold gave plus 4%. 81 was negative, minus 25, minus 22. Then again 82. At some point of time, drawdown was 23%, means paper loss was 23%. Over the year, you got plus 19%. So over the course of the graph period of the graph, you can see more of green bars, only a few red bars, which means in spite of all these red bars, drawdowns across the years, there are only a few red bars and mostly green bars. So, on a 1 year basis also, if you hold on for at least 1 year, volatility does happen, but you end up getting positive returns in most of the years. Now, a bit of a global thing. Globally, why it is a diversifier? Look at global periods, historical phases, when equity has gone through bear phases. And in that bear phase, gold has given either positive or relatively better returns, which is why gold is put as a portfolio diversifier. So look at this time period. So from 1929 to 1932, the US market, S&P 500, US equity market. US equity market S&P gave minus 86% return. And over that period, gold gave plus 0.29. You might think it is nothing, only plus 0.29. But the point is, in a phase when equity as an US equity, S&P 500, when equity gave minus 86% returns, gold gave plus 0.29. So on the right side, towards my right, what the column shows is you add up the two, as in gold has beaten this minus 86.19%, plus gold has given plus 0.29%. So add up the two, you get plus 86.48. So gold has outperformed equity in that bear phase, not throughout, by the way, only in that bear phase I'm talking about. If gold has outperformed equity by 86%, you can see here 86.48%. Similarly, 56 to 57, equity minus 21.6%, gold also minus, but only like minus point something, minus 0.11. Overall outperformance 21.52%. So as you see here, except this one phase like 80 to 82, you can see here 1980, 1982. Equity was minus so much, 27%, and gold was minus so much, minus 45%. So only here it is a red tick, as in gold has underperformed equity. Otherwise, if you look at this, it is mostly green, as in gold has outperformed equity in bear phases, not like overall kind of thing, only in bear phases. So you can see here the mean and median. So mean, this is minus 34.85, and here it is plus 43.89. So in bear phases, in case something happens to equity, then gold acts as a good, store of value or a hedge, what you call it. So coming to investments into gold, what are the arguments for investment in gold? Whatever extent, 10%, 15%, whatever percentage, how much? So one of the arguments is to say that historically, as a ballpark, not always, but as a ballpark, interest rate, US Fed fund rate, US Fed rate, and gold has an inverse relationship. And from now on, the view is that US Fed will cut rates. US economic condition is not good. So they will have, that's the market view at least, not my individual view, it's the market view, that US Fed will cut rates significantly. So US Fed rates, they have already cut by 1 percentage point, and they will cut further. So the expectation is when US Fed cuts rates, gold price goes up. So you can see here the phases here, like here, this green shaded portion, US Fed cutting rates. Here, this green shaded portion, US Fed cutting rates. So when US Fed cuts rates, usually gold does better. Gold gives higher returns. That is the view as of now. That is one argument in favor of buying gold. And then the big reason here, the big thing, you all know it, geopolitical tensions. So the way the gold is shaping up, the big daddy US, they are gradually going away. You know all that stories that is happening. And the respect for USA all over the world is on the way down. And with that, with Big Daddy gradually going away, all these regional issues will be on the higher side. Even with USA itself, all these regional issues, tensions would be on the higher side. So in times of geopolitical tensions, gold functions as a store of value, as in equity, equity may not do well during geopolitical, if something happens, if war happens or something, then equity does not, or equity may not do well. So in those terms, like I showed you, equity bear phases, gold acts as a store of value. So what is happening? Over the past some time, in particular, after the breakout of the Russia-Ukraine war in 22, and the US and Europe putting sanctions on Russia. What are they were doing now? They're doing to India and they're doing to all other countries of the world. All these things happened. Central banks all over the world, they are gradually diversifying away their reserves from US dollar. It will not happen overnight. It is a it is a huge chunk, huge quantum. It won't happen overnight. But the process has already begun, not today, but the process has already begun earlier. Incrementally, central banks all over the world, they are not buying US treasuries, not about the USD, it's about diversifying away from US. To give an example, US treasuries, who buys US treasuries apart from people in US itself? Foreign countries, sovereigns, governments, central banks, and all that. Sometime earlier, China was the biggest holder of US treasuries, government bonds. Today, China is not first, not even second, only the third largest holder. Today, Japan is the biggest holder, second biggest is UK, and third is China. So basically what they're doing is they are selling US and they're buying, diversifying away. Now, when we say diversify away from the global reserve currency, what is the option or what are the options? There are only two options, crypto and gold. And crypto, as you know, there is no sanctity whatsoever. It's like whatever, I mean, I won't put any word to it, you know it. Whereas gold has proven itself over the ages. It's an historical asset, as old as, kind of almost as old as history. So like in India itself, we are Indians, we know Indian history, and you know the position of gold in our history. So like that way, gold is as old as history. And crypto is whatever, I mean, I won't put any word to it. So that way I would, so those who want to diversify away from the formal US kind of thing, for diversification away, gold is a thing. So you can see some numbers here. Average before the outbreak of the Ukraine war, and this is the green horizontal thing. And this red thing, average after the outbreak of the Ukraine war. So what is this? Global central bank gold purchases. So before the Russia-Ukraine war broke out, and before Russia, so US and all those, they drove away Russia from the SWIFT system, as in the banking SWIFT system. They declared Russia as defaulter just because to show them as defaulter, they forfeited Russian money, and all those things happened. After that, the global order is changed. Not only after that, even before that it started, now it is more accentuated. The global order is changing. The central banks all over the world are buying more of gold. You can see the numbers here. Average over a long period of time before the Russia-Ukraine war, so much, 118 tons. And after the war, so much, 291 tons. So central banks are buying more of gold. So how much? So global gold reserves as a, so first of all, to clarify here, some people think that printing of money, printing of currency, be it US dollar or be it Indian rupee, happens against gold. No, that system has gone 50 years ago. That is, so nowadays central banks can print as much money as they want. Central banks don't need to have gold in their coffers to print money. So like US, it is said that whatever money the US has in circulation today, the countries are 20 to 150 years old, 35 to 40% of that has been created post-COVID. That is what the rough ballpark data is. What I'm telling you here is, like India, RBI. RBI has forex reserves and all that. So that reserves, how much of it is in gold? So RBI approximately 12, 13% is in gold. So you can see here, central bank, whatever reserves they have, how much percentage is in gold, you can see here. From like less than 10%, now it is like 18, 20, whatever percent. Central banks are preferring to hold more of their reserves in gold, means they are moving away from USD and moving into gold. So it's a long text here. Just read the text here. I have taken, it's not my text. I've taken this from Incrementum. Incrementum, as you can do Google, you can find out. They are kind of specialists and kind of authority on data on gold. So this is what Incrementum has said and what they have found out. The most relevant is function as a long-term store value inflation hedge, followed by performance during times of crisis and effective portfolio diversifier, as in why people should buy gold. While the former reasons have been on the podium since 2020, the latter replaced the record winner historical position. So now, if you read between the lines, effective portfolio diversifier, for reasons of political correctness, people will not say in bold fonts in so many words that we no more trust USA, we want to move away from USA. That is not a very palatable kind of thing. to put it in writing in so many words. So they will not say it in so many words. They will say effective portfolio diversifier. That is what the message is as to why people buy gold. So again, some more data, central banks net gold purchases. So you can see here how much gold they have been purchasing. So you can see here 2000, 2001 and all that they have been selling. 2011, 12 they have been buying gold. So you can see this also, this yellow curve also you can see here. So the gold price, it has a very big relationship. So the text also you can, I hope you can read here. Central bank gold purchases from 2000 to 2016 totaled so much, $85 billion. In a single year, 24, central banks bought gold worth $84 billion. I'll read this again, it is worth digesting. Central bank gold purchases from 2000 to 2016 totaled $85 billion. In a single year, 24, central banks bought gold worth $84 billion. So think about it. What is happening in this? So one example, like central banks buying gold, you can see China. So look at this. For China, US Treasury holding on the left-hand side and gold reserve on the right-hand side as percentage of total Chinese FX reserve. So look at this. Chinese FX reserve in US Treasuries, like approximately 40% here. It's approximately whatever, 20 odd percent, whatever percentage here. So like from 40% to 20 odd percent, it has come down so much. And gold on the right hand side, it was like, how much was it? Like maybe say 2% thereabouts earlier. Now it is like 6-7%. So gold from like 1-2% earlier, now it's up to like 6-7%. That is an idea of the extent of shift in reserves of China. So whatever has happened today between not only US, China, all countries, US, China, US, India, US versus the entire world. Because today Trump thinks he is the president not of USA, but he thinks he's president of the entire world. So he has taken on the entire world. So all these things are happening. And look at the correlation here. PBOC as in People's Bank of China, the central bank, like our RBI. PBOC gold reserves in tons and gold price. So look at this high level of this thing. The extent to which gold reserves have moved up, the dark blue kind of shaded portion, and gold price. There's a very big, very high correlation. Now comes ETF. ETF as in, you know it, exchange traded funds. So on one hand, there are central banks buying gold like we just discussed, and there is investment demand also. Now, investment happens in which form? Mostly the bulk of it, like you can see here, happens in non-physical form, ETF. So by the way, ETFs like in India, we have mutual funds in India, and we have mutual funds issuing gold ETFs or gold funds. They have to have the physical gold. So typically what mutual funds do is, so they will have to have that physical gold in their coffer, in their vaults. Now the business being different, it is not the job of a mutual fund to do safekeeping of gold. So usually what they do is they outsource. There are specialized agencies for doing that. So the mutual fund will pay some nominal fees to that agency, specialized agency. They will import the gold, put it in the coffer on behalf of the mutual fund. As against that physical gold, the mutual fund will issue ETF units. So investment demand, and you can see here. So you can see the regions here, like North America, Europe, Asia, and all that. So largely North America and Europe. So investment demand for gold is driving it. So central bank purchases and investment demand that is driving the gold thing. So why investors want to buy gold? What are the parameters or rationale? You can see here so many things. Long-term investment is the most popular one. Then performance, whatever returns gold has given over a long period of time. Protection against financial crisis, we saw it earlier, like bear phases or things like in some particular geopolitical crisis or tension. Then inflation protection, diversification we just discussed, wealth accumulation. So for wealth accumulation, while equities and bonds are always there, you can have some gold also in your portfolio, like 10 to 15% in your portfolio. Tangibility, you can have a look and feel. Protection against geopolitical crisis, anonymity, and all those things are there. So these are the reasons why investors would buy gold. Now, what is the sources of demand for gold? Now, typically in my sessions, now when I ask people that who buys gold, and the most frequent answer is women. So See this in perspective. When we say woman, okay, we are all Indians, we know the history of gold and all that. But the point here is demand for gold as jewelry is there only in India and to an extent in China, India and China. Look at the West, US, Europe, other countries. No demand for gold for jewelry. Use of gold as jewelry is there only in India and China. So what are the sources of demand? We discussed two this thing so far. We discussed central bank purchases and we discussed ETF as investment. So there is an agency like a mutual fund who will have the physical gold and issue ETF units, and people, investors invest in those ETF units. So here we see all the sources of demand for gold. So look here, jewelry. So this dark blue kind of thing. So in the bar, that dark blue component is jewelry. So jewelry demand also is there. Technology. So I'm not sure. Maybe if you know better, things like say mobile phones are certain one of those chips and certain circuits and all that. I'm told certain chips and circuits require a bit of gold for the lining and all that. That is technology. Bar and coin. So that also is investment demand. So this is physical. So investment demand can be physical like bars and coins, can be non-physical like ETFs and all that. So you can see here the bars and coins, this bluish kind of color, then ETFs, and then central bank net purchases. So the purple portion of the graph, that is central bank purchases, that is driving demand. Demand for jewelry also is there, India, China, or whichever country it may be there. Investment demand in both physical and non-physical form. Physical form as in bars and coins, and non-physical ETFs, and I'll show you some more formats also. So just read this text. Again, not my text, it is from Incrementum. Like I told you, they're a specialized agency doing research on gold. So it says a comparison of the three major gold bull markets confirms that while history does not repeat itself, it does rhyme. Despite differences in the bull markets, the structural similarities of the underlying conditions outweigh the differences. So basically, lot of text here, basically to say that when we look at the earlier bull phases of gold and the modern phase, yes, there are certain similarities. So currently it could be a bull phase for gold. So gold and US equity. For a very high level, macro level kind of idea between gold and US equity. So gold market cap to US market cap, equity market cap, you can see here over a long period of time. Jan 1925 to April 25. So basically 100 years of history. So over this 100 years of history, gold market cap to US equity market cap has been approximately 40%. You can see the number here, median 37.9%, so about 38%. So total market cap of gold has been approximately 38% of US equity market cap. So here, when we are saying, you all know that gold price has gone up, you may be thinking that while gold price has moved up, even after moving up, it is like at the long-term average median, whatever it is. It is only at the long-term average, not high. The thing is, past few years, US equity also has moved up. So US equity has moved up, gold price has moved up. So at the end of it, as of today, we are kind of at the median, which means some upside is still there. Now coming to the Indian part. So since we are Indians and we invest in gold in India, so whatever returns we have got till today, only one part of it has been returns from gold price per se. The balance of it has been rupee depreciation. So what is the meaning of this? What is the meaning of gold price per se? So if you want to know, or if you want to compute or look at the returns from gold per se, if you want to track gold prices, it is LBMA. You can do a simple Google and you will get it. LBMA stands for London Bullion Market Association. So they are like kind of the global, what do you say, a central agency or whatever what you call it. They are the central agency who will publish the price of gold, like maybe in USD or UK, British pound and all that. That's a USD. So it's called fixing, AM fixing and PM fixing. AM as in time, AM, PM. So whatever that fixing, LBM, AM or PM fixing, they will say price so much. That price is, let's say, in USD. That is gold price per se. So on the website of LBMA, you can find the history and you can see what returns gold has given over a long period of time. That return is in dollar terms only, whereas the returns we get in India is in Indian rupees, which adds rupee depreciation to the returns from gold. How does it happen? As an example, sometime earlier when rupee was say 60 or 70 or 80, gold so much in dollar. Today rupee is like say 87 or whatever number. So rupees depreciation from 80 to 87. So earlier it was gold price per se in dollar multiplied by 80. Today it is gold price per se as in dollar multiplied by 87. Multiplier has gone up. So rupee depreciation adds to your gold returns. So I'm giving you some ballpark idea how much. So you can see here, year 2000, USD returns minus 5.3%, INR plus 1.4%. So in rupee terms, gold has given plus 1.4%. 2001, USD terms 2.4%, INR terms 5.8%. So across most of them, you can see this thing. So towards the end, you can look at this CAGR over this long period of time. In USD terms, this CAGR is 10.1%, INR terms 13%. So this differential between 10% and 13%, this differential of 3% is rupee depreciation, which adds to returns from gold per se. That is the part because rupee has always depreciated, and from now on, hopefully the pace of depreciation will be lower than earlier, but whatever it is, we do not really expect rupee to appreciate because we have a current account deficit. So rupee depreciation will continue to add from returns from gold, as in gold price per se, which is in USD or something, to so I'm almost towards the end of my thing. So I will now discuss how can you invest in gold. So what are the multiple avenues, various avenues, how you can invest in gold. Physical gold, you know it. There is no limit. Now, when we say physical gold, so jewelry also is physical gold. Jewelry also is physical gold. Bars, points also are physical gold. So there's no limit as such. Gold ETFs, there are limits. So the mutual funds issue this product. So what is the difference between a gold ETF and a gold fund of a mutual fund? In gold ETF, the mutual fund has gold in their vault or in an outsourced vault. They will issue the ETFs. Those ETFs are listed at the exchange. Exchange means NSE. So like how you trade one equity stock, you open an account with a broker, conventional broker. And nowadays we have these apps and all that. Account with a broker, and you trade equity stock. Similarly, you trade ETFs. You buy and sell multiple times in a day or whenever you want. A gold fund is, so to buy a gold ETF, what is required is a demat account. So there may be some people like whatever, senior citizen or whatever, some section of society who may not have a demat account. So for those people, there is a gold fund. So gold fund of the mutual fund, what they do is they invest in gold ETFs of the same house. So ABC Mutual Fund issues ETF units. ABC Mutual Fund Gold Fund will invest in ETFs of that same house. There's some bit of additional expense ratio, and it is not compulsory to have demat account or broker account and all those things to invest in a gold funds as such. Sovereign gold bond, you know it, and this also will be aware that today there is no fresh issuance of sovereign gold bonds. So you can still buy, but from the secondary market only. Now there is no fresh issuance. And this product called digital gold. So depending on the distributor, there may be some minimum amount, and you can, so basically non-physical form, you can use digital gold. Safety security, physical gold, be it jewelry, be it bars, pearls, yes, risk of theft is very much there, we take care of this thing. Gold ETF is safe. It is the ETF, underlying gold is there. Sovereign gold bond. Now, one remarkable thing here, you may be aware, you may not be aware, one remarkable thing is sovereign gold bonds do not have the underlying. A mutual fund, so just like this, that if a mutual fund, maybe PSU, maybe private sector, whatever, if they don't have the gold in their coffers, they're in the, or in the outsourced, people will doubt, oh, you don't have gold, how can you issue and all those things? Whereas sovereign gold bond, it is government, Sarkar. So Sarkar can do anything. So Sarkar issued sovereign gold bonds. So you get the gold related returns, plus you get interest also. But the government did not have or does not have equivalent gold or any gold under them. There is no underlying thing as such. you only get gold related returns. So it is very safe. It is issued by the government of India. So, and there's no physical distance, it's completely safe. Digital gold also is safe. Transaction cost, physical gold, yes, it can be high, particularly if it is a jewelry. So when you go to the jeweler to exchange and all that, then they will point out this, that, and all those things are there, you know it. Gold ETF transaction cost is low. There may be some brokerage cost, but yes, nowadays there are certain brokerages, zero discount brokerages, app-based, they charge zero or very low brokerages. So it is kind of low. Sovereign gold bond, same fund and low. Digital gold also, it's not, it's kind of low. Collateral for loan, yes, you can. Sovereign gold bonds, you can pledge for loan. Tradability, physical gold, I mean, there's no question of trading at the exchange. Gold ETFs are at the exchange only. Sovereign gold bond, apart from the lock-in period, I mean, yes, it is tradable. Digital gold, yes, you can trade on certain platforms. Lock-in period is, so in sovereign gold bond for 5 years, it is lock-in. You cannot, you have no liquidity. Otherwise, in all other forms, be it physical, be it ETFs or whatever, you can. Whenever you want liquidity, you can sell, provided there's a buyer. Return, so in line with price, the only exception is sovereign gold bond. Sovereign gold bond is the only product which pays you an interest over and above the price return of gold. This interest rate earlier used to be 2.75%, and it was 2.5%. Now there is no fresh issuance. So depending on which product you are buying, which STB you are buying, if it is an old 2.75 wala or more recent 2.5% wala, which is over and above the price return of gold. Purity of gold, physical, I won't comment on that, whatever it is, so-called 24 karat and all that. Gold ETF is very high. There is a specialized agency looking into it. Sovereign gold bond, it doesn't matter. I mean, there is no underlying gold and it is issued by the ultimate authority, which is the government. If I may use this term, government is like my bar, so they can do anything. So it's pure gold related return and there is no even question of the purity of that gold. Digital gold also, it is supervised by the regulator, SEBI and all that. So it's kind of high purity. Storage cost depends on you. If you go to the bank vault, yes. And nowadays we hear stories about bank vaults also. So that cost is there. Gold ETF, it's like, demat account, it's very low. Sovereign gold bond also is like, it's very low kind of thing. And tenure, so physical ETF, there's nothing. Sovereign gold bond, it is 5 to 8 years, 5 years lock-in and 8 years is the tenure of the product. So that's about it. So to summarize the discussion, what is the view on price of gold? My view, my individual view, you may disagree. The view is positive because, so what are the drivers of gold price today, or why, what is the rationale for my giving a positive view? Geopolitical tensions. So central banks will continue buying more and more of gold. Jewelry demand, whatever it is there. Investment demand. So both central bank demand due to geopolitical tension and investment demand will remain and will rather go up. Why? So because of whatever is happening, whatever the US is doing, whatever is happening all over the world, people who want to move away from the formal system, USD or any other system, only two options, crypto and gold. Crypto price also is going up, but it is highly risky. Even my individual view, cryptocurrency is not an investment asset. Equity is an investment asset. Debt or bond is an investment asset. Gold is an investment asset. Real estate also is an investment asset. But crypto is not an investment asset. So if we leave aside crypto, that means gold. Like we saw, the global ETF investments are on the higher side now. That will very much remain. Interest rate. So interest rate, US Fed rate cuts expected. That will support gold prices and USD. So the ballpark is between US dollar and gold. It is an inverse relationship. So dollar. So if US Fed cuts rates, the expectation is that dollar will weaken going forward. And if a dollar would gradually lose the position as the reserve currency of the world, that also may lead to USD weakness. So that also is a ballpark support for gold. Level, I don't know. So like long back when gold was like 50 or 60,000 rupees per 10 grams, someone asked me, can it be 1 lakh? I said, I don't know. Honestly, I didn't know. Today it has crossed 1 lakh. Today, if you ask me what level, I don't know. All I'm saying is that because of these factors, these support factors are there. And as I said, diversify 10-15% of your portfolio, not like 40-50%, 10-15% of your portfolio diversify into gold. At the end of the day, you will get better risk adjusted or better volatility adjusted returns. So with that, I will pause here. I then pause my PPT and I will go to the chat box. So, okay, one question I see on screen is rise in index, I don't know which index, and gold price will weaken the strength of rupees add to inflation. Okay, so in inflation, yes, I don't remember the exact number, whatever weightage is there or not there, but there are certain reports that, yes, gold does add to inflation to a certain extent. But weaken the strength of the rupee to a certain extent in the sense, see, why does rupee weaken? We have a current account deficit. Why do we have a current account deficit? Because we import more than we export. And what do we import? The biggest import is crude oil, and the second biggest import is gold. Now, crude oil, no one can complain. So many things, you know it. So many things are required. We require crude oil imports. But gold is, in a sense, non-productive. Non-productive in the sense it does not have industrial application, jewelry, investment, whatever. So to that extent, to the extent gold is adding to the current account deficit, to a marginal extent, yes, it does add to rupee weakness, which is why in the first phase the government wanted to introduce this product called sovereign gold bond. The government thought we will not have physical gold, we will just give the gold-related returns to investors, and to that extent we will reduce the import of gold. It didn't really work out well, whatever. So to an extent, yes. Uh, can you suggest some good mutual funds or ETFs for beginners to start with? Okay. So as a whatever norm, regulation or norm in a SEBI or NISM kind of session, no speaker should take any product name, any fund name or any product name. So I'll give you a broad guidance. There are so many mutual funds or so many ETFs available in the market. You simply go to AMFI website, just click on that product, this thing, and performance, you will see so many gold ETFs. The parameters for you can be that if you want to choose, there is ETF A, ETF B, ETF C, and D, and so many. Your parameter for choosing would be that one is a bigger fund size, not to say bigger is better, but to say that a bigger fund size means more investors, and more investors means potentially higher liquidity. So when you are buying into an ETF, you would prefer more liquidity, that if and when you want to sell, there should be a buyer. So a bigger fund size means more liquidity. So that way, and you can check returns also, that some NISBs can be there. On the go to the AMFI website, you can check the returns, historical returns, fund size and everything you can check, and you can make your own choice. Can we increase gold investment than equity at least for 20%? No. If you are thinking of a particular year, that is not investment. If your purpose of investment is long-term wealth accumulation, then don't think year-wise. You have to think 10-year-wise or 15-year-wise. For your 10, 15, 20-year horizon, you have some equity in your portfolio, have some bond in your portfolio, have some gold in your portfolio, have some real estate and whatever any other tangible good asset class you should have in your portfolio, in a ratio, in an allocation that suits your profile. If you can do it yourself, good. Or if not, you go to a SEBI registered investment advisor or an AMFI registered mutual fund distributor. They will guide you about your allocation. Okay, so what is the ideal percentage allocation to gold of total investment? As I said earlier, 10 to 15%, not very high. My logic is gold is not a productive asset. It's only a portfolio diversifier. ETF and mutual fund for gold for beginners, I could not take. Oh, you go to the AMFI website, click on the button for fund performance. On that, you go to ETF, look at gold ETF, and you will get all the data on performance, the data on fund size and all those things. Accordingly, you can take your own decision. Whether silver or gold is expected to give high returns. I would say both. Because see, as against gold, silver has a somewhat higher industrial application. And silver is doing well now, but experts are saying that historically whatever silver has done, it has a good scope now. So if you have say 10% allocation to gold, you can have like 3, 4, 5% allocation to silver also. And nowadays there are silver funds also. So rather than a physical form, you can have it in a non-physical form also. physical gold or gold bond, which is better? I would say a non-physical. That too, sovereign gold bond. Unfortunately, there is no fresh issuance nowadays because sovereign gold bonds had an interest of 2.75 or 2.5% over and above the price return of gold. There is no fresh issuance now. You can buy the secondary market. So there is, as an example, if gold gives you 7 or 8 or 9% return, over and above that 7 or 8% return from gold per se, you get 2.5% additional return from sovereign gold bond. What could be entry buy price of gold in current situation? No, don't do market timing. Look at any market, equity or any market. Trying to time the market has always been futile. Forget all that. You buy it like equity. So if you wait for index correction that I will enter equity at index level so and so, it doesn't work. You have money, you invest with a long-term horizon. So no expert can time the market. Which way you think most appropriate and effective one in terms of non-physical, and within that sovereign gold bond is relatively better. Suggested companies to purchase digital gold from? No, I will not name because as I said, in a SEBI or NISM kind of session, we cannot or should not talk about any particular product or product provider. So I will refrain from taking any names whatsoever. When we purchase gold from ETF and MF, did they purchase physical gold? If yes, where is it? That is said now. I said twice. Yes, they do. So mutual funds, what they do is they do buy physical gold. So there is an importing agency. There is one Bank of Nova Scotia. There are so many banks. There is one Bank of Nova Scotia. They are specialists in importing gold. And after the gold is imported, there are certain specialized agencies like you would have seen on the road now, like on the bank ATMs. On the bank ATMs, when they fill cash, the cash comes in a van with all those, guns and all those uniform police type of people. So who are those? They are specialized agencies who specialize in carrying cash with security and all that. Similarly, there are specialized agencies who have gold in their vaults. So the mutual fund will outsource. The mutual fund will say, okay, you agency, your security agency, you buy this or have this gold in your vault on our behalf. Something like you have this custodian. So who is a custodian? A custodian for a mutual fund is a mutual fund buys equities and bonds. The mutual fund, instead of holding it themselves, it gives to the custodian. The custodian holds it on behalf of the mutual fund or on behalf of the unit holders. Similarly, instead of the conventional custodian like a bank or something, it is given to a security agency who has the gold in their vaults. How do you see gold ETFs and silver ETFs next 5 to 10 years in returns? I can't give a number. Yes, I am positive. You should have some allocation in the portfolio. Okay, so did I miss any question? Any information about next sovereign gold bond issue? So what I'm hearing is, at least as per the media, government has stopped issuing sovereign gold bond. That means no further issuance. I'll give you the background. Initially, when this government launched this product, government's thought was, we will not have underlying gold. To that extent, we will save on importing of gold because that's a drag on our forex reserves. And people in India who have a view on gold that I want to benefit from gold price movement, we will mitigate that demand as in we will give them gold price based return plus some return of 2.75 or 2.5%. Now things have changed. Now the government has realized that, whatever gold price has gone up, that hit is coming on the government's exchequer. So now what I'm hearing is there will be no further fresh issuance of SGB. You can buy from the secondary market. ETF or digital gold, similar. I don't see any big difference. Is it good idea to invest in a multi-asset allocation mutual fund for gold allocation in portfolio? Yes, you can do that. But it's like this. If you are attempting 10% allocation to gold in an overall portfolio, so it depends. In the multi-asset fund, if you have some number, whatever, say 20% or whatever percentage, if you have 20% of your portfolio in a multi-asset fund, that fund has 10% allocation to gold. So only 10% of that is allocation to gold. Whereas if you want to have 10% allocation to gold in your portfolio, then you have to have 100% multi-asset allocation fund. So that call you have to take. How much of gold you want to have in your portfolio and not just one particular fund. So if you have 10% in your fund, in your portfolio in one multi-asset fund, and that fund has 10% in gold, you have only like 1% of your portfolio in gold. Able to share presentation? No, as an NISM, no, presentation is not shared. As Sahil said earlier, the recording of this session will be available on the, like Sahil will repeat that, it will be available. You can see the recording of this session. Sovereign gold bond is not issued ETF or fund of fund. ETF is better from the perspective that gold fund of fund adds one layer of expenses. So as long as you are savvy enough to open an account with a broker and demat account and all those things, by going for gold ETF, you save on that leg of the expense. Gold fund of fund has a slight advantage in the sense your liquidity is guaranteed. In the sense, gold ETF, when you want to sell, hopefully there will be some buyer. In case there is no buyer, but in a gold fund of a mutual fund, when you put in the redemption request, a mutual fund cannot refuse. Mutual fund cannot say, we will not give you money. Is ETF investment safe? Do they invest in physical gold as ETF? Already said it, ETF is safe. So there is underlying gold. One, this thing could be that the price of the ETF in the secondary market may be different from the NFA of the fund. So to a certain extent, all this intraday or even interday also, price differences can happen. But that apart, little bit of price difference here and there from the intrinsic NFE of the fund. That apart, yes, there is no safety issue as such in ETFs. So I think investing 24K gold and ETF save in returns. See, I won't say in so many words, 24K. What I'm told is physical gold, even if it is 24K, I will not say. You can form your own impression. Whereas ETF is that much safer. 50% debt, 10% equity, 30% in gold. No. Equity have your as per your risk appetite. Debt as per risk appetite, gold like 10-15%, not like too much in gold. Okay, so I think it is already beyond 5, it is 5:03. So not sure if there are more questions. Sahil, are you there?
Yes, sir.
Yeah, so your concluding comments, please.
Yeah, thank you so much. Means I would like to extend our heartfelt thanks for taking time and speaking at the webinar. Your insights, expertise, and presentation as well made a lasting impact on our audience. Thank you so much again for your time and
Thank
knowledge.
you.
Wishing you a wonderful day. Thank you. Thank you.
Bye.
Sir. Bye. Bye. Thank you to participants as well for joining us today. Yeah. Thank you all. Sir, now we can end this session.